Hello, everyone, and welcome to the Professional Development Financial Wellness presentation. Today we'll be talking about risk management. So I'm Jonathan Glenn with Shoemaker Financial, and again we'll be talking about risk management. There's several different areas or categories of a well-designed or well-built healthy financial plan. Those 6 key areas really are listed out here in this slide, but we'll be focusing on the insurance planning or risk management area today. Again, in looking in specifically the insurance planning side of a financial plan, there's really 6 key areas that are crucial or critical to building a healthy insurance plan for worst case scenario, for different scenarios in life. And those are listed here. Medical insurance or health insurance, most of the time or a lot of the time is provided by an employer, and the employer may help pay for a portion or even all of that. Long-term care, which is normally for aging parents or yourself as you get older up into your 40s. I've even seen as early as the 40s, but 50s, 60s, and 70s for sure. Disability income or disability insurance, which is to protect against loss of income in the event of sickness or injury. Property or casualty insurance, which is home and auto insurance and everything within the home as well. Liability insurance or umbrella insurance, which protects some assets that you may have on top of a home and auto. So normally there's home and auto insurance and umbrella insurance, which is on top of that, and then life insurance, which obviously is to provide a lifestyle for your family once you're gone. So first we'll be covering medical insurance, and I tell this story a lot with one of my clients who we had tried to get him to evaluate his medical insurance that he had at a certain point, and found out that he liked to play softball and played pretty regularly on a weekly basis, and he's an outfielder in left field. And one day he calls me up and says, Jonathan, I was playing softball the other night, and I need to pull some money from my account. And I said, well, what's going on? And he said, well, I was playing softball the other night, and obviously, I'm out in left field, and I missed the ball. It hit the tip into my glove and broke my nose, and had to go to the hospital emergency room and get surgery done, and had some stents put in his nose to help the healing process, and all of that cost $6,000. So it's really critical to have a healthy medical insurance plan or a strong medical insurance plan in place, so that you don't have to dip into savings if you don't need to, and because a lot of times there's people who don't have the proper coverage, and then they end up having to take out credit cards or loans to pay the medical bills back, and it just turns a bad situation and makes it worse. Long-term care is the second area of insurance planning or risk management that's really critical and is ever so getting more important and more expensive for a couple of reasons. Number one, long-term care insurance is designed to help take care of an aging loved one who may need help just doing 6 activities of daily living, or 1 or 2 of the 6. Normally, so of the 6 activities, there's eating, bathing, dressing, continence, transferring from room to room, and toileting. So of those 6, if someone cannot do 2 of those 6 daily activities, basic daily activities, then they can then file a claim to be paid on a long-term care policy. So a lot of times an aging loved one, once they have hit that point where they can't do 2 of the 6 activities of daily living, they then may need to go to a nursing home or assisted living facility where someone can help them with those activities, but they're not totally dependent upon someone else. Or they may decide to have someone come in the home to help them with those activities, or at least come in the home temporarily, like for a couple hours a day or an hour a day, to help them get ready for the day. And then once they're ready, then they can go about their day. But that's the design of long-term care and what it's for. Most people don't realize how expensive it is, but we'll talk about that in the ensuing slides. One of the most important questions that I get, or one of the most important things to consider is, this is all fine and dandy. The idea of long-term care is nice, but how much does it cost? And so looking at the cost of that, it's been something that insurance companies have had a hard time pricing because it's been going up so rapidly. So if you think about cost of living or inflation, which is typically about 3% per year, which is the same reason why a Coke back in my father's day, when he was a child, was about 15, 20 cents, and now a Coke is $1.50, $2. So that's what had led to that was inflation, or cost of living going up about 3% every year. So long-term care goes up about double that, so 6 to 7% per year. So it's been something that's very difficult for insurance companies to price. And so but as of today, even these numbers here, nursing home costs of about $250 per day, that comes out to about $91,000, $92,000 per year. And these numbers are again several years old. So if we were to think about that today, in today's terms, here in the Memphis area, if you were to be admitted to an assisted living or nursing home facility such as Ave Maria, which is one of the nicer in Memphis, that would cost at least a minimum of $100,000. An assisted living facility that's not a full nursing home would cost about $3,600 per month. So it's really critical to make sure that you plan in advance, because there's many people who don't think about this as a risk or a concern, and then when the time comes, they do need to be admitted to a facility because they can't do 2 of their 6 activities of daily living. Simple, basic daily life activities: eating, bathing, toileting, transferring from room to room, things like that. When the time comes and they can't do these activities, they have to be admitted to one of the facilities or have someone come in the home. And when that happens, it costs a lot, and it can really drain your life savings down very rapidly. And so I've even seen cases where the husband can't do everything that he used to do. He can't walk and move like he used to could, and needs help transferring from room to room and eating. And the wife had to take care of the husband, but she can't really pick him up. She can't help him move around and walk like he used to could. So they have to be admitted to a long-term care facility, an assisted living facility. And unfortunately, it costs so much that they drained their life savings down, and he passed, leaving her with nothing. And so she really came to a crossroads where she had to either get a job and go back to work, or ask for help among the family. So it can really make a bad situation tougher, or a tough situation tougher, by not considering long-term care and looking at how much it will cost. The second point on this slide is, could you afford to self-insure? And a lot of my clients who are on the higher income earning side, they try to self-insure, meaning they say, well, okay, instead of me buying an insurance policy that would pay $90,000 to $100,000 a year, I'm just going to save up about $90,000 to $100,000 a year, and I want to assume that I basically need it for 4 years. So we're looking at $400,000 to $500,000 that I need just for long-term care insurance. And so a lot of those clients will try to self-insure and save that portion of money for themselves. Another area of risk management, which in my opinion is probably the most important of all of the insurance planning areas, is disability insurance, or income protection. And the reason I say that it's the most important is because your income is the cog that turns all of your life. The bills come, you always have expenses and bills and things that come along, but without your income, you really can't do anything. Everything goes away. Your lifestyle completely changes and just crumbles without your income. And so I ask my clients this question all the time when we first meet: is, how do you plan to take care of your family if something were to happen to you and you were to get sick or injured and were unable to work. What type of planning have you done in the event of that happening? And it really is something to consider, because especially if only one spouse works, where there's only one income coming in, and if that person were to get sick or injured, then it would put a real strain on the family, and things would just fall apart. So disability insurance is meant to protect against that, and to pay a portion of income back to the policy owner if they were to become sick or injured outside or inside of the job. So critical in the insurance planning process. Another area of risk management is property and casualty insurance. And property and casualty insurance, home and auto insurance, homeowners insurance is required when you buy your first time home, or when you buy any home. You have to have that house insured before you close on the house. And it is also meant to protect assets inside the home. So, for instance, I had one of my good friends who owned a home, and he had the right amount of homeowners insurance, and his house caught on fire and burned, and everything inside the house was completely destroyed. They didn't have enough time. Family didn't have enough time to get out and pull everything out of the house. They all were safe. They all got out quickly, and no one was injured, but everything inside the house was destroyed. And so fortunately, they had the right type of coverage and right amount of coverage to where the insurance company paid, and they did replace everything that was inside the house. And it's really important to plan and make sure that you have the right type of coverage, because not all homeowners insurance policies are the same. So that's really critical when looking at your insurances. Again, understanding homeowners insurance is really important in the home buying process, because a lot of homeowners insurance certain policies may pay for certain things, and other policies may not pay for those very same things in the same scenario. For instance, buying a new roof can cost upwards of $10,000, $15,000, $20,000 sometimes, and there is certain policies that may not pay a dime on a roof, even though there's evidence that the roof is damaged and has been damaged by an act of God or some other reason, and the insurance policy may not pay. So it's really critical to understand and to be very intentional about where you're pointing your dollars with homeowners insurance. Automobile insurance is another area that falls under the home and auto. And saving on automobile insurance is important because there's certain times in life where cash flow is tight, and you can only afford what you can afford, and want to make sure that you still have good coverage on your car if something were to happen to you and you were to be in a car wreck. So there's certain ways to lighten the load, so to speak, on the bill for paying for automobile insurance. Things like buying a higher deductible, lower premium, so that if something were to happen, you would have to shell out a little bit more in the event of something actually happening. But being able to save an emergency fund to pay for whatever the deductible is, because at the end of the day, you know what your premium is going to be, but you don't know if you'll be in an accident. You don't know how much that will cost, but you do know the deductible portion, and you do know that you can save that in your bank account or an investment account. And if you can have that saved in advance, then a strategy to help save money on your insurances, not just car insurance, but health insurance as well, is to have a higher deductible, to lighten the load a little bit. Umbrella liability insurance is another area of risk management, and this is really critical in this day and age which we live, because we're always pressed with lawsuits, and we see them all around us, and they happen very frequently. So we live in a very litigious society, And it's important to have the right type of and right amount of umbrella insurance to protect against lawsuits and things like that. I'll give you an example. For instance, let's say I'm in a car wreck and I'm at fault. I hit a car, and there's a family of 4 in the car that I hit, and they are injured. They then sue me for $1 million. And the insurance company does their due diligence. My car insurance company, they write me a check for $50,000, which is pretty standard coverage. Write me a check for $50,000, and then they would basically say, okay, well, you're on your own. Good luck on the rest of the lawsuit for the $1 million, or the rest of the $950,000. And then from there on out, I would be pretty much on my own, fighting my own battle. And worst case scenario, the family would then be able to draw on my assets, or if I were to lose the lawsuit, then they could garnish my wages and they could take my assets that I had. So an umbrella insurance policy is designed to protect against that. Most umbrella insurance policies pay about $1 million or $2 million of coverage as the protection. So the $50,000 that I earned from the insurance company that paid out, since I was at fault, the umbrella is meant to go on top of that car coverage or the home coverage to help protect against lawsuits and things of that nature. So that's what it's designed to do. Life insurance is another area of risk management, which in general is pretty simple. I think everybody pretty much understands the basics of life insurance. It's designed to pay a death benefit or pay a lump sum of money to my family if something happens to me and I die prematurely, or if I die at a certain age, then it provides a lifestyle for my family or someone that I care about after I'm gone. The biggest question that I receive in the life insurance side of things is, how much do I need, Jonathan? And I ask this question a lot to most, or really all my clients, is, has anyone ever walked you through an analysis of figuring out how much insurance you need? How much life insurance do you actually need? And most of the time the answer I hear is no. And so here on this slide we have an example of a basic calculator providing the amount of insurance needed. So if we look at the top line here, let's say it's a family of 4, again the Smith family, and the first line is dependents' total living costs. So meaning this is the cost, all of their expenses, their day-to-day expenses, everything. If you were to lump all of their budget together and say, well, this is what they spend on a yearly basis, it's $100,000. They have 2 incomes. The husband makes the majority of the income, and Mrs. Smith, the wife, makes $30,000. So Mr. Smith passes away prematurely. Their expenses that they have from both incomes and providing the lifestyle that they have is $100,000. He is gone, and so the lion's share of the income is gone with him, and the only income that's available now with Miss Smith working is $30,000. So they have automatically right off the bat they have a big gap of $70,000 that's a big hole in their financial picture, and so they need to either spend less or save more, or make more money. And so they understand that they can't really make more right off the bat. You can't just go from making 30 to making $100,000 just like that. So they would then have to adjust their lifestyle and then completely downsize their lifestyle, which would be really, really tough. So the gap there in line 3 under the orange line, there is additional income needed, $70,000. We gathered that. And so the anticipated investment return, anywhere from 0 to 10%. Normally, even though 7 is listed, normally I like to say 3 to 4%. The 4% rule, some of you can look that up if you want, but basically states that, if I'm going to have a lump sum of money and I'm going to draw 4% of that, what is the amount of money that I need to provide the $70,000 of income? So if we use the 7% rule here, then $1 million of coverage would provide $70,000 if you draw 7% of the $1 million every year. The only problem is it's very difficult to earn a rate of return to keep up at that pace. So my job as an investment advisor would be I need to manage money properly so that I can earn 4% each year on that life insurance investments, so that the family can then draw 4% of that money to equal $70,000 to provide for that lifestyle, to continue that lifestyle just as is. So in reality, even though it says $1 million here, Mr. Smith, if something were to happen to him, if he were to pass away prematurely, he probably would need more than $1 million. Matter of fact, I know he would need more than $1 million. He would need at least $1.5 million, probably $2 million of coverage. So this is a pretty straightforward example of just basic expenses and figuring out how much insurance someone may need. Let's talk about the different types of life insurance. So really and truly, there's only two different types of insurance. There's term insurance and permanent insurance. And permanent insurance is categorized into several different subcategories: whole life, universal life, and variable universal life. So the first category, term insurance, is really like renting a house or renting an apartment. You pay a certain amount of money to the insurance company, and they promise that they'll give you X amount of dollars as insurance. Let's say $1 million. We used that in our last slide. So you pay a certain amount of money to the insurance company, and they promise that in the term that you've bought, let's say 30 years. Typically a term will last from, there's terms of 10 years, 15 years, 20 years, 30 years. I've even seen 35-year term insurance policies. But let's say I purchase a 30-year term insurance policy. So I'm 25. That means the insurance policy would last me until I'm 55. So that's the 30-year term, and that's $1 million coverage. So if I pass away any time in those 30 years, then the death benefit is paid out to my loved ones. And then if I live beyond the age 55, then the insurance company doesn't owe me anything back. I have no cash value, no growth of the insurance policy. So it's like I say, just like renting a house. Permanent insurance is a different category, where really there's three different subcategories: whole life, universal life, variable universal life. Whole life is the first subcategory. Whole life is just how it reads. It's designed to last your entire life, and it's typically a little bit more expensive because there's cash value inside the policy on top of the insurance, so that you can draw from that policy tax-free if you need it. Universal life is similar in that it works the same way. The basic bells and whistles, or the basic structure chassis of the insurance, is a permanent life insurance policy, except for the investments inside the policy. The cash value that we just talked about is a little bit more aggressive and is designed to have a higher rate of return. Variable universal life is the third subcategory, and similar to the first two, whole and universal life is designed, the chassis is the same. So it's permanent insurance designed to last the rest of your life if you want it to, but the investments inside the policy are a little bit more aggressive than the other two. So it's designed to create more cash value growth so that you can have a lot more money to draw on if you needed to. This concludes the Professional Development Program Financial Wellness presentation on risk management. Thank you for your time. I really appreciate you taking the time to listen and go through the slides today. If you have any questions or concerns, or just want to connect with me, or reach out and ask any follow-up questions, I'd love to hear from you. You can reach out to me at my email, which is jglenn@shoemakerfinancial.com. Again, I'll spell that out: jglenn@shoemaker financial.com. You can also reach me at my cell phone. You can call me or text me 901-238-7800. Thanks so much.